AM Best is releasing a series of reports in August and September on the global reinsurance industry to coincide with Rendezvous des Septembre in Monte Carlo. This lead article takes an overarching view of the reinsurance landscape, and here to discuss the latest trends and AM Best outlook on the industry is Carlos Wong-Fupuy, Senior Director, AM Best. And Carlos, in the previous report, you spoke quite a bit about traditional risks taking on unpredictable patterns. Is that still a predominant theme in the new report, and how are reinsurers reacting?
I think one of the big themes that we're discussing this year, and this is a continuation from what started last year, was the increased level of uncertainty when we talk about pricing in this risk environment. And something very evident is happening on the property cat side. So the frequency of events, even in years which are not characterized by a major catastrophic events, let's say the last 2 years, we've had increased frequency of medium to small sized events, which in aggregate have translated into $120 billion plus dollars, which is equivalent to a major catastrophic year. So yes, what we see is companies, risk managers getting much less comfortable about deploying capital, and say investors are not happy definitely with this level of volatility, and there is a significant shift in business models. So in terms of how capital is being deployed, what we can see is companies are trying to stabilize the results, protect their balance sheets, and move into what is considered more attractive or even more predictable areas such as casualty, primary, specialty lines of business.
The shifts that you speak of, are they leading to better performance?
I think that it's probably still early days, but we have definitely seen some changes. 2021, for example, is the first year that when we look at the global composite numbers, is the first year when we see a combined ratio below 100% within the last 5 years. We have seen as well this effect not just coming from stabilization of losses, but companies have become a bit more efficient in terms of their operational costs as well. So there is a slight decline in expense ratios. When we think about companies meeting their cost of capital, that's still a bit of a mixed bag. And there is still some noise in terms of investment results. Markets have been relatively volatile in the last few years. Some companies have benefited from this, some others less so. And another important component as well is the level of reserve releases. So in the last few years after the events in 2017-18, we saw a significant decline in reserve releases. That has started to recover a bit now, but going forward, we would expect that effect to stabilize.
Specific to Florida, should we expect to see any positive changes in the near term?
When we think about global reinsurers operating in Florida, one of the things that we need to realize is that the issues in the Florida market are not necessarily directly linked to the fact that this is a cat-exposed area. So they have their own dynamics, and they have their own long-term issues based on the regulatory environment, legislative challenges, more recently, credit quality of a number of primary carriers, the potential for litigation and fraudulent claims. So reinsurers are very careful on how they operate in that market. During the last renewal cycle, we've seen a certain level of dislocation, sharp increases in prices, a few gaps in terms of reinsurance programs. But what we see from the global reinsurers' point of view is that to the extent that they can assess properly the cedents they are prepared to support they are still committed to the market. What we don't see is any increased optimism about actually expanding their participation in that market.
Carlos, kind of a tricky question, but do you think risk modelers are falling behind? And if that be the case, how should reinsurers be reacting?
I think that risk modelers are definitely under increased scrutiny, but the validity of models, I believe that probably in the past has been a bit overstated. Yeah, I think that the challenge is as much on the modelers as on the users of the models. I think that in the past, especially when it comes to catastrophe modeling, there are probably been some players which have been a bit complacent about vendor model results. And in this current environment, I think that it's more important that risk takers actually take a more proprietary view of the risk. So models are always going to be an important input, but by no means are 100% solution. We have a number of lines of business which are much more difficult to model than cat risk, such as specialty, liability, and those are the ones which are attracting capital at the moment. So I think that as long as say investors and risk managers understand that the models are only one very important but not the only component in the risk assessment process, the role of models is going to continue to be as important as ever.
Do you think the various forms of government intervention is having any impact on the reinsurers?
I think that government intervention, unfortunately, is a factor that has become more and more evident when we think about claims experience. Probably the most clear example of that has been the COVID pandemic. Yeah, so the major the most important component of losses wasn't mortality, which was properly adequately incorporated in pandemic models, but business interruption, which was the result of government actions in terms of lockdowns, restrictions of movement, and that's something which is almost impossible to predict. More recently, and again related to that, we can think about the economic environment. Say when we talked about the effects of the pandemic, for example, the first idea was fears of recession, of lower economic activity that we could see at the beginning, but nobody actually could predict the impact that was going to come from economic stimulus measures. And now we are talking about an inflationary environment, which obviously companies have to incorporate in their planning going forward. Just a year ago, we were talking about companies trying to continue to adapt to a long-term, low-interest rate environment. That picture has completely changed in a matter of months. And that has an impact not just in terms of market asset values of investments, but on how companies deploy their capital, because obviously the way investors see reinsurance compared to other alternative investment options is changing a lot.
Carlos, for years, AM Best cautioned reinsurers about an over-reliance on reserve releases to boost the bottom line. Where does AM Best stand on that today?
Mm-hmm. Until 2017-18, yes, we had seen companies relying probably excessively on positive reserve releases from previous years. And the clear picture about how profitable a particular accident year wasn't very clear. Now, since then, companies have become much more cautious. Yeah, it was because of the cat events 2017, 18, later because of the pandemic. So we have seen a much more prudent approach regarding reserves. In the last 2 years, that picture has started to revert a bit. I think it's too early to tell. We don't think that it's going to get back to the levels that we had in 2016, 15, which were about 6% of combined ratio. At the moment, they are more around probably 3.5%, and that's probably a level where companies will stabilize going forward. But another point that we need to make here is that until a year ago, probably especially with long-term lines, companies hadn't factored fully the effect of inflationary pressures. So I believe that any potential redundancies that companies may have at the moment in their reserves are actually probably have to be assessed considering those inflationary pressures which may erode that level of comfort.
So, to wrap it all up, what's AM Best's outlook for the reinsurance sector?
Well, for another year, we are keeping the outlook as stable. And as we have said before, it's not because we think that nothing is changing. On the contrary, we think that there are a number of positives and negatives which in some way offset each other. There is no dominant factor. But what I would say is on the positive side, the sector remains well capitalized, is still well disciplined. We have this increase in rates, terms and conditions, which is actually lasting for longer than in previous cycles. Increased demand for reinsurance, because the need for protection is something that we see from the primary carriers as well. On the negative side, there are a number of challenges. So inflation, potential for recession, this increased uncertainty about the risk environment. And I would say most of all, long term, it is we have an economic environment which is shifting more into so-called non-tangible assets, cyber risks, and until now, companies have been very cautious on how they deploy capital and how they adapt to that new risk environment. So I think that it's a significant challenge and an opportunity as well.
Carlos, pleasure to speak with you.
Thank you very much, John.
That was Carlos Wong-Fupuy, Senior Director, AM Best. You can find the full article online at ambest.com. For AM Best TV, I'm John Weber.